How to calculate the break-even points of an iron condor. Are you curious about how to determine the break-even points of an iron condor? This options trading strategy can be a great way to manage risk while aiming for profit. Let's break it down step by step. An iron condor involves for options with the same expiration date. You sell an out-of-the-money put option and buy a lower strike put option. Then, you sell an out-of-the-money call option and buy a higher strike call option. This setup creates a position that benefits from low volatility. To find the break-even points, you first need to know the strike prices of the options you selected and the net credit you received when you entered the trade. The net credit is the total premium you received from selling the put and call spreads, minus the premiums you paid for the bought options. Now let's get to the calculations. There are two break-even points to consider. The first is the lower break-even point. You calculate this by taking the strike price of the short put option and subtracting the net credit received. The second is the upper break-even point. For this, you take the strike price of the short call option and add the net credit received. For example, let's say you sold a put option with a strike price of $45 and bought a put option with a strike price of $40. You also sold a call option with a strike price of $55 and bought a call option with a strike price of $60. If you received a net credit of $2, your calculations would look like this. For the lower break-even point, you would do $45 minus $2, which equals $43. For the upper break-even point, you would do $55 plus $2, which equals $57. This means that if the stock price at expiration remains between $43 and $57, your iron condor position will be profitable. If the price moves outside this range, you may start to incur losses, but those losses are capped by the bought options. For day trading or trading with small capital, knowing these break-even points is essential. It helps you manage your risk and set your exit targets effectively. Since the iron condor strategy profits from low volatility and time decay, understanding where your break-even points are allows you to make timely adjustments to your positions. If the underlying stock price approaches either break-even point, you might consider rolling your spreads or extending the expiration date. These adjustments can change your break-even calculations and potentially widen your profit range. In summary, calculating the break-even points of an iron condor involves knowing your strike prices and the net credit received. This calculation is a key part of managing your risk and planning your trades effectively.